In 2024, Renaissance Technologies Medallion Fund, the most secretive quantitative fund on Earth, returned over 30% net of its notoriously punishing fees. It did that using AI and machine learning that it has been refining since 1988. Here's the part that should bother you. The gap between what institutional AI can do and what retail investors are doing is not closing. It's accelerating. But here's what almost nobody is talking about. For the first time in market history, a meaningful subset of those institutional-grade tools are now accessible to individual investors. The question isn't whether AI is changing markets. It already has. The question is whether you are on the right side of that structural shift, or whether you are the inefficiency someone else's algorithm is exploiting. Let's start with the most uncomfortable truth first. The research process that worked in 2015, read the 10K, check the earnings call transcript, monitor analyst upgrades, is not just less effective in 2025, it is actively counterproductive because it gives you false confidence in an edge you no longer have. Here is why. In 2015, a diligent retail investor who spent a weekend reading through a company's financials genuinely had an information advantage over someone who hadn't. That advantage lasted days, sometimes weeks. Today, large language models can ingest an entire 10K, cross-reference it against every prior filing, compare management language patterns against a database of thousands of other transcripts, flag sentiment drift, and surface a risk-adjusted summary in under 90 seconds. Goldman Sachs, Citadel, and Two Sigma are doing a version of this at scale, in real time, across the entire market. The information half-life has collapsed. Morgan Stanley published internal research in late 2024 estimating that the market's price discovery speed, the time it takes for new public information to be reflected in price, has decreased by roughly 60% since 2019. That is not a marginal change. That is a structural rewiring of how markets work. So what does a serious retail investor do with this? You stop competing on information speed, because you will lose. You start competing on interpretation and patience. Two things AI is still genuinely bad at. The actionable insight here is this. Your research process should now begin where AI ends. Use AI to compress the commodity part of your workflow, data gathering, filing review, sector comparison, and redirect your human time toward the contrarian thesis construction that requires judgment, context, and the willingness to hold a position through volatility. That is still a human advantage. For now. Now let's get specific, because this is where most coverage of this topic completely fails you. People say, use AI for investing, without telling you what that actually means in practice. Here are 3 concrete tools institutional players use, and what the closest retail accessible equivalents look like today. First, alternative data sentiment analysis. Firms like Point72 and Millennium spend 7 figures annually on natural language processing systems that monitor earnings call tone, SEC filing language patterns, social media velocity, and even satellite imagery of parking lots. The retail equivalent that has matured significantly is a combination of tools like Quiver Quantitative and stock analysis that's layered with custom GPT-4 prompt workflow. Not identical, but directionally useful, and the cost delta is around 99.8% cheaper. Second, factor model construction. Institutional quant desks run multi-factor models that dynamically weight momentum, value, quality, and low volatility factors based on prevailing market regime. In 2025, Composer and Portfolios Lab now offer retail investors the ability to build rules-based, factor-weighted strategies without writing a single line of code. Backtesting is built in. Execution is automated. This did not exist in any meaningful form 5 years ago. Third, real-time risk monitoring. Risk management, not stock picking, is where AI generates the most durable alpha in institutional settings. Tools like Kensho, originally built for Goldman Sachs, now have commercial API access. For retail, the equivalent is running a structured risk dashboard in Python or using platforms like Thinkorswim's ThinkScript with volatility regime triggers baked in. This is not financial advice, it is a map of the terrain. The point is that the tooling gap has narrowed. The execution gap, meaning your discipline and your willingness to build a systematic process, remains entirely within your control. Here is what the sell side won't tell you plainly. AI-driven momentum strategies have been the single best performing systematic approach in 2024 and early 2025. And they are also among the most fragile strategies in existence when market regimes shift. The data on this is unambiguous. The AQR Momentum Fund, which runs a systematic data-driven momentum strategy, returned approximately 18% in 2024. Compare that to the S&P 500's roughly 23% return, and momentum looks modest. But adjust for volatility and momentum's Sharpe ratio, the return per unit of risk was materially superior. The reason AI-driven momentum works is precisely because it is systematic. It has no ego, no anchoring bias, no reluctance to cut a losing position. It executes the rule every time. But here's where it breaks. AI momentum strategies failed spectacularly in March 2020, in Q4 2018, and during the rate shock period of mid-2022. In each case, the strategy's historical training data did not adequately model a rapid regime change, a sudden shift in the macro environment that invalidated the pattern the model was optimizing for. This is called model brittleness, and it is the central unsolved problem in applied AI investing. The practical implication for you, if you are incorporating AI-driven signals into your process, and you should be, build explicit circuit breakers. When the VIX spikes above 30, when the Fed surprises, when credit spreads widen faster than historical norms, your AI toolkit needs to be paused or at minimum down-weighted. The investors who get hurt by AI tools are not the ones who use them. They're the ones who trusted them unconditionally. Systematic does not mean infallible. It means consistent. And consistency still requires human oversight at the regime level. Before the outro, one quick note on execution infrastructure, because strategy only matters if your brokerage isn't eating your returns and fees. I use Robinhood for commission-free equity trades and Webull when I want more granular technical charting and extended hours access. Both are free to open, both execute at market standard speeds, and neither charges you a commission on stock or ETF trades. If you're still on a platform charging per-trade fees in 2025, that is a solved problem. Links to both are in the description. And if you want the actual AI research workflow we use at Synthetic Alpha, the GPT prompt library, the screener templates, the factor model framework, that is all packaged in our toolkit on Gumroad at syntheticalpha.gumroad.com. It's designed for people who want to build a systematic process, not people who want to copy trades. We started this video with a simple question. Are you on the right side of AI's structural shift in markets, or are you the inefficiency being exploited? Here's the honest answer after everything we covered. You cannot outcompute a hedge fund, but you can outpatience one. You can use AI to compress your research workflow, access factor-based tools that didn't exist 3 years ago, and build circuit breakers that keep you from trusting any model unconditionally. That is a real, defensible edge. The follow-up question this raises, and the one we're covering next, is whether AI can actually